Hi everyone, today we are starting with the EA Part 1 Individual. So, before we study the deductions, credits, and capital gains, we must build the correct foundation. So, EA Part 1 is not about memorizing the rules, it's all about this understanding the flow of Form 1040 and the law behind this form. So, let's begin with this module number 1 Tax Fundamentals. So, here we will do fundamental basics. So we'll see now what is federal income tax. So federal income tax is a compulsory payment imposed by the national government of the United States on taxable income. It is the payment which is imposed on the taxable income. So federal means basically the national level. Central level, you can say national level. So that govern all the 50 states. It's called national level. It is different from the state tax and local tax also. The federal government has their three branches. First is Congress. Second is Treasury and IRS. You can say IRS and Treasury. And third is court. Okay, Congress writes the law in the Internal Revenue Code. So under IRS section 1, only once you earn taxable income you must pay tax. If you earn, you must pay tax. So it is compulsory. It is not based on wealth, property, ownership and spending. It is based only on income earned during the year. If you can earn, you can pay. You have to pay. So if you don't earn, no federal income tax will be imposed on you. Let's understand with the following example. Suppose Rahul is working in the US. Rahul work in New York in US. He earns $80,000. You can say $80,000 in 2025. He did not sign the any special contract agreeing with the paying taxes. But under the law, under IRC Section 1, you must pay the federal income tax because it is compulsory. When you earn the taxes, when you earn the taxable income, you owe the tax. You earn the taxable income 2025, you owe the tax. You are eligible for paying the taxes. Now second, we will continue with the annual accounting system. US follows an annual accounting system. This means each year standalone. Income and deductions are calculated separately for each year. You cannot average the income across the years. If you earn $2 lakh in 2025 and $0 in 2026, $0 in 2026. So you cannot combine them. You cannot combine together. Each year is taxed independently. This is taxed independently and this is also taxed independently. This is why the timings of the income matters here in the annual accounting system. Now third point is sources of tax laws. Sources of tax laws, where does tax laws come from? You have a question in your mind, I think. Where does the tax laws come from? There is a hierarchy of the tax laws. I'll tell you the hierarchy is US Constitution, International Revenue Code, IRS, third is Treasury Regulation, fourth is court cases, fifth is revenue rulings, and then revenue procedures. Seventh is IRS publication. If there is any conflict of the in all of them, so higher authority wins. The Internal Revenue Code is mainly actually main law. Treasury regulation explain how to apply it, and IRS publications are helpful but not legally binding. Now, next point is filing requirements. Who must file the federal income tax return? So if the gross income exceeds the threshold of your filing status, you must file the income tax. But there's a special situation. Even with low income, you must file if net self-employment income is $400 or more. Or you can say more. You owed additional taxes also. You received advanced premium tax credit. Dependents have different filing thresholds actually. So low income does not always mean no filing required. Not every time. And fifth point is filing status. So filing status is standard deduction, tax rate. It actually affects from these things: standard deduction, tax rate, and then credit eligibility. Now there are 5 statuses. This is very important. First is single. Second is married. Filing jointly. And third is married filing separately. Fourth is head of household. Okay. Fifth is qualifying surviving spouse. Okay. So basically key rule, you can say marital status determined on 31st December. I'll tell you behind this what is that. So head of household is heavily tested on. You must be unmarried, pay more than half the cost of the home, and have a qualifying person. So now I'll tell you the marital status is determined on 31st December. So I'll tell you the example why is this that. So even if you married at December 31st at 11:59 p.m. also, 59 p.m. also in the last minute. So it is considered married for whole year. Okay. Now let's understand the next point, dependents. So there are only 2 types of dependents: qualifying child and qualifying relative. Qualifying child requires relationship, age, residency, support, joint written test. Qualifying relative required not a qualifying child, relationship or live all year, gross income below the threshold, and taxpayer provide more than the 50% support. So dependents affect credits and filing statuses. Now the last point is 7th point, tax year and accounting methods. Most individuals are actually using the calendar year, January 1st to December 31st. Accounting methods determining the time. Cash method, income taxed when received. Okay, income is taxed when it is received. Expenses deducted when it is paid. This is very important. Income taxed when received. Expenses deducted when it is paid. When it is paid. Now accrual basis income क्या है? Income taxed when earned. Expenses deducted when it is incurred. So individuals mostly use the cash method. This connects directly to the constructive receipts or the. Now we can say we have covered all the topics in overall. Like we will do some depth examples and some depth questions of all these topics in the next lecture. So in this lecture, we have covered what is federal income tax, annual accounting system, authority hierarchy, filing requirements, filing statuses, dependents, cash versus accrual method. So this is the foundation module 1, and we will do module 1 again in the depth with example and with some questions in the next lecture. Thank you.